Welcome to our deep dive into equity financing, a powerful tool for businesses seeking growth. Equity financing is all about raising capital by selling shares of your company to investors. This method is widely used by startups and established businesses alike, offering a pathway to secure funds without taking on debt. In this video, we'll explore how equity financing works, its benefits, and what you need to know to make informed decisions. Let's start by understanding the basics and why so many entrepreneurs turn to equity financing as their preferred funding strategy. Equity financing involves selling ownership stakes in your company to investors in exchange for capital. Unlike loans, you don't have to repay the money or pay interest. Instead, investors become partial owners and share in the company's profits and losses. This approach is especially popular among startups that need significant funds to scale quickly. By offering shares, you attract investors who believe in your vision and are willing to take risks alongside you. Understanding this fundamental concept is crucial before considering equity financing for your business. There are several types of equity financing, each suited to different stages of business growth. Common options include angel investors, venture capital, crowdfunding, and public offerings. Angel investors are individuals who provide early-stage funding, often in exchange for a significant equity stake. Venture capital firms invest larger amounts in high-growth companies, typically expecting substantial return. Crowdfunding allows you to raise money from a large number of people, usually through online platforms. Public offerings like IPOs enable companies to sell shares to the general public. Choosing the right type depends on your business needs and goals. Angel investors are typically wealthy individuals who invest their own money into promising startups. They often provide not just capital but also mentorship and industry connections. Angel investors usually seek a sizable equity stake reflecting the risk they take on. Their involvement can be pivotal in the early stages, helping startups refine their business models and accelerate growth. If you're considering equity financing, understanding how angel investors operate and what they look for can help you attract the right partners. Venture capital firms are professional investors who pool funds to invest in high-potential startups. They typically provide larger amounts of capital than angel investors and often require board seats or influence over company decisions. Venture capital is best suited for businesses with rapid growth prospects and scalable models. The process involves rigorous due diligence, and investors expect substantial return. If your business is ready to scale and you need significant funding, venture capital could be the right path. Crowdfunding has revolutionized equity financing by allowing businesses to raise capital from a broad audience. Through online platforms, companies can offer shares to many small investors. This democratizes investment and can build a loyal customer base. Crowdfunding is ideal for businesses with strong community appeal or innovative products. However, managing many shareholders and meeting regulatory requirements can be challenging. Understanding the pros and cons of crowdfunding helps you decide if it's the right fit for your business. Initial public offering or IPO is when a company sells shares to the public for the first time. This is a major milestone, providing access to vast amounts of capital and increasing visibility. IPOs are complex and require compliance with strict regulations. They're best suited for mature companies with proven track records. Going public can transform your business, but it also brings new responsibilities, such as transparency and shareholder management. Understanding the IPO process is essential for long-term planning. Equity financing offers several advantages over traditional debt. You don't have to repay the funds or pay interest, which eases cash flow. Investors often bring expertise, networks, and strategic guidance. Sharing ownership can align interests and foster collaboration. Equity financing is especially valuable for businesses with high growth potential but limited assets. By leveraging investor support, you can accelerate expansion and innovation. Understanding these benefits helps you weigh equity financing against other funding options. While equity financing can fuel growth, it also comes with risks. Selling shares means giving up partial ownership and control. Investors may influence key decisions, which can lead to conflicts. Dilution is another concern, as issuing more shares reduces your stake. Regulatory compliance and shareholder management add complexity. It's important to carefully consider these risks and ensure you're comfortable with sharing control. Balancing the benefits and risks is key to successful equity financing. Equity financing differs fundamentally from debt financing. Debt involves borrowing money and repaying it with interest, while equity means selling ownership stakes. Debt is less risky in terms of control, but it adds financial pressure. Equity offers flexibility and access to expertise, but you share profits and decision-making. Choosing between equity and debt depends on your business stage, cash flow, and growth ambition. Understanding the differences helps you make informed funding decisions. Investors assess businesses based on several criteria before committing capital. They look for strong management teams, scalable business models, market potential, and clear exit strategies. Financial health, growth prospects, and competitive advantages are also key factors. Investors want to see a compelling vision and evidence of execution. Preparing your business for investor scrutiny involves refining your pitch, demonstrating traction, and addressing potential risk. Knowing what investors value can help you attract the right partners. Preparation is crucial when seeking equity financing. Start by developing a solid business plan, financial projections, and a compelling pitch. Identify your funding needs and target investors who align with your vision. Legal considerations such as shareholder agreements and compliance are essential. Building relationships and networking can open doors to potential investors. By preparing thoroughly, you increase your chances of securing the right funding and setting your business up for success. Pitching to investors is an art and a science. Your pitch should clearly communicate your business model, market opportunity, and growth strategy. Highlight your team's strengths and demonstrate traction with real results. Investors want to see passion, vision, and a realistic plan for scaling. Practice your pitch, anticipate questions, and be ready to address concerns. A strong pitch can make the difference between securing funding and missing out. Negotiating the terms of equity financing is a critical step. Key elements include valuation, equity stake, investor rights, and exit options. Both parties must agree on how much the company is worth and what percentage of ownership is being sold. Investor rights such as board seats or veto power can impact company decisions. Exit options define how investors can cash out, such as through a sale or IPO. Careful negotiation ensures a fair deal and sets the stage for a productive partnership. Legal considerations are vital in equity financing. Shareholder agreements, compliance with securities laws, and proper documentation protect both parties. These agreements outline rights, responsibilities, and dispute resolution mechanisms. Compliance ensures you meet regulatory requirements and avoid penalties. Working with experienced legal advisors can help you navigate the complexities and safeguard your interests. Legal diligence is essential for building trust and ensuring a smooth funding process. Valuation is a central issue in equity financing. It determines how much your company is worth and how much equity you'll need to give up for the capital you seek. Valuation methods include discounted cash flow, market comparables, and asset-based approaches. Accurate valuation attracts investors and ensures fair deals. Overvaluing or undervaluing your business can lead to problems down the road. Understanding valuation helps you negotiate confidently and secure the right funding. Dilution occurs when a company issues new shares, reducing the ownership percentage of existing shareholders. While dilution is a natural part of equity financing, it's important to manage it carefully. Excessive dilution can erode control and reduce incentives for founders and early investors. Strategies to minimize dilution include negotiating favorable terms and planning future funding rounds. Understanding dilution helps you protect your interests and maintain a strong position as your business grows. Investors often seek rights and protections to safeguard their interests. Common rights include board seats, veto power, and information access. Protected provisions may cover anti-dilution, liquidation preferences, and tag-along rights. These terms ensure investors can influence key decisions and protect their investments. Balancing investor rights with founder control is crucial for a healthy partnership. Understanding these provisions helps you negotiate effectively and build lasting relationships. Exit strategies define how investors can realize returns on their investment. Common options include selling shares in a secondary market, acquisition by another company, or an IPO. Clear exit strategies attract investors and align interests. Planning for exits ensures you're prepared for future transitions and can manage shareholder expectations. Understanding exit options is essential for structuring deals and building investor confidence. Regulatory compliance is a critical aspect of equity financing. Companies must adhere to securities laws, disclosure requirements, and reporting standards. Non-compliance can lead to penalties and legal issues. Staying informed about regulations and working with legal experts helps you avoid pitfalls. Compliance builds trust with investors and ensures a smooth funding process. Understanding regulatory requirements is essential for long-term success. Managing shareholders is an ongoing responsibility in equity financing. Effective communication, transparency, and regular updates foster trust and engagement. Shareholder meetings, reports, and feedback channels help maintain alignment. Addressing concerns and resolving disputes promptly is essential. Strong shareholder management builds loyalty and supports business growth. Understanding how to manage shareholders ensures a positive experience for all parties involved. Equity financing can accelerate business growth by providing the capital needed for expansion, innovation, and talent acquisition. Investors often bring strategic guidance and industry connections, helping you scale faster. By leveraging equity financing, you can pursue new markets, develop products, and build a competitive edge. Understanding how to use investor support effectively is key to maximizing growth opportunities. Equity financing presents challenges such as managing investor expectations, navigating complex negotiations, and maintaining control. Balancing the interests of multiple stakeholders can be demanding. Regulatory compliance, shareholder management, and dilution require careful attention. By anticipating challenges and preparing solutions, you can navigate the equity financing process successfully. Understanding these hurdles helps you build resilience and achieve your goals. Let's look at a real-world example of equity financing in action. A tech startup raised capital from angel investors and venture capital firms, using the funds to develop its product and scale operations. The investors provided not only money but also mentorship and industry connections. The company grew rapidly, eventually launching an IPO and delivering strong returns to early investors. This case highlights how equity financing can transform a business and create value for all stakeholders. Another example involves a consumer product company that used crowdfunding to raise equity capital. By engaging a large number of small investors, the company built a loyal customer base and generated buzz. The funds supported product development and marketing, leading to rapid sales growth. Managing many shareholders was challenging, but the company's transparent communication and strong community engagement paid off. This case demonstrates the power of crowdfunding in equity financing. Equity financing is evolving globally, with new platforms and regulations shaping the landscape. Crowdfunding, cross-border investments, and digital tools are making it easier for businesses to access capital. Emerging markets are seeing increased activity as investors seek new opportunities. Staying informed about global trends helps you adapt and leverage new funding sources. Understanding the changing environment is key to successful equity financing. Small businesses can benefit from equity financing by attracting investors who support their growth. Local angel investors, community funds, and crowdfunding are accessible options. Equity financing helps small businesses expand, innovate, and compete. However, managing investor relationships and compliance is essential. Understanding how to tailor equity financing to your business size and goals ensures you maximize its benefits. Established companies use equity financing to fund major expansions, acquisitions, or new product launches. Institutional investors, private equity, and public offerings are common sources. Equity financing provides flexibility and access to strategic partners. Managing dilution, shareholder expectations, and regulatory compliance is crucial. Understanding how established companies leverage equity financing can inform your own strategy. Future of equity financing is bright, with technology and innovation driving new opportunities. Digital platforms, blockchain, and global networks are making fundraising more accessible and efficient. Investors are increasingly focused on impact, sustainability, and diversity. Staying ahead of trends and embracing innovation can help you succeed in the evolving landscape. Understanding the future direction of equity financing prepares you for long-term growth. Equity financing is a versatile tool for raising capital, offering benefits such as access to expertise, flexibility, and growth potential. However, it also involves sharing ownership, managing risks, and navigating complex negotiations. By understanding the types, processes, and challenges of equity financing, you can make informed decisions and build lasting partnerships. Whether you're a startup or an established business, equity financing can unlock new opportunities and drive success. Thanks for joining us on this journey through equity financing.